Hi, I'm John Prasinos, Editorial Director of Investing Daily. Welcome to my latest video presentation. In this video, I conduct a question and answer session with Jim Fink, my colleague who operates Velocity Trader, a premium trading service that consistently beats the markets. In today's interview, Jim will reveal some of his secret methodologies for racking up huge gains for his followers. Jim, thanks for joining us here today.
Great to be here, John. I always enjoy talking about the wonderful world of options, so thank you for this opportunity.
Yes, the wonderful world of options. Most investors are accustomed to trading stocks on a buy and hold basis, but you take a different approach. Explain that for us, please.
Sure. Stocks can double or triple over time, but it usually takes years to happen. But there is a way to generate such 100% and 200% returns much more quickly, in days rather than years, and that involves the use of options as a substitute for stock. In chemistry terms, call and put options are like the atoms that make up a stock molecule. When you buy a stock, you are buying exposure to the full range of a stock's price movement, up and down, for an unlimited period of time. Stock is a very blunt and expensive investment instrument that's sort of like being forced to buy a 300-channel cable TV package when all you want to do is watch Nickelodeon and the Food Network. Options allow you to limit your capital at risk to only those portions of a stock's price movement that you want, and for only the period of time you think necessary. This provides the trader with the ability to benefit from a stock's price movement, but at a much lower cost than buying stock. But there is yet another step you can take with options to reduce your risk even further. It is a secret that option professionals have been using for decades, but which has only recently entered the mainstream. This extremely powerful tool is known as spreading. Remember, since an option is a derivative contract, it can be sold without owning it first. By selling an option at the same time that you buy an option, you can actually help finance the cost of the purchased option and lower your cost basis even further. Remember, a lower cost basis while maintaining the same profit potential increases your rate of return. Because the outperformance of spreads is limited to cases where the stock rises only modestly, option traders often characterize spreads as possessing regional leverage. Within the region of modest price appreciation, the spread simply can't be beat. But individual calls will outperform in cases where the stock makes a huge price move. But isn't it better to bet on modest price moves than huge price moves? You betcha it is. Another advantage of selling a call to reduce cost is that you can often totally eliminate the time value surcharge on the long-term call option that you are long. In other words, you get all of the upside of stock ownership, up to the strike price of the sold call, that is, at a fraction of the cost of stock, and without suffering any time value decay, which is the best of both worlds. In other words, stock options provide tremendous leverage that speeds up profit generation far beyond what is possible with stock ownership alone. Generating huge profits in a short amount of time through the use of options is a concept I call velocity trading.
Jim, investors generally fear volatility, at least on the downside, and I can understand why they'd find it unnerving. But from your perspective as a seasoned options trader, how does volatility create new opportunities to make money?
Well, John, when you say volatility, I'm glad you clarified this. I assume you meant downside volatility, because I don't know any investor who dislikes the type of price volatility that causes their stock to go up. But even for regular stock investors, downside volatility is only bad for the stocks they already own. For the stocks that they don't yet own but want to, downside volatility is actually a good thing because it enables the purchase of a stock at a low bargain basement entry price. Option traders also can benefit from sudden and temporary reductions in price that allow them to buy call options cheaply for less money or to sell put options for more money. Call and put options are, after all, derivatives of the underlying stock, and calls typically go down in value in parallel with the stock price going down, while puts typically go up in value opposite to what the stock price is doing. But for option traders, volatility offers opportunities not available to regular stock investors. You see, whereas the underlying stock is valued based on the company's assets and future earnings potential, the primary component of an options price is implied volatility, which measures trader expectations about future price volatility. If a stock plunges in price, investors get fearful that the stock will fall even more, and that fear increases demand for protection and pumps up the price of both call options and put options. So option traders benefit from downside price volatility in two ways. First, the lower stock price itself, and second, higher option values caused by pumped up implied volatility. Interestingly, a call owner can actually experience the value of his call increasing despite the stock price decreasing, which sounds counterintuitive until you realize that the implied volatility component of the call option can skyrocket so high that it more than compensates for the stock price decline. This is why owning a call can actually provide a hedge against a declining stock price, whereas a regular stock owner feels the full effect of the price decline. The negative corollary of this, however, is that buying a new call option after a price decline may not be as cheap as you would expect, and thus not that profitable once a stock price rebounds. But you can get around this problem by buying a call spread. In other words, simultaneously both buying and selling different call options, instead of just buying an individual call by itself. For a put owner, a stock price decline has a double-barreled positive effect because the put value increases from both the stock price decline itself and from the increase in implied volatility of the put option. The positive corollary of this is that selling a new put after a stock price decline brings in a boatload of income that often far exceeds what you would expect from the stock's price decline alone. Selling puts is often more profitable than buying calls during a stock market decline because of implied volatility expansion. One of the great things about options is the ability to sell an option that you don't yet own for income.
You know, Jim, the more volatile the stock market, the wider premiums on options can get. That obviously means fatter potential profits from selling them. But isn't there a correspondingly greater risk as well of getting called out of positions at less than optimal prices?
Well, if by getting called out, you mean being involuntarily assigned early on an option position that you are short, in other words, that you have sold to open, I would not be concerned about that. For example, if one has sold a 150 strike put on Apple with the underlying stock currently trading at about, I think it's 151 right now, and the stock were to drop precipitously down to $140 a share, it is true that if you were assigned early on the 150 put, one would be required to purchase the stock at 150, despite the stock currently trading at only 140. But remember that you received a substantial premium for selling that 150 put to begin with. Say you received $5 a share in income. So your net purchase price, if assigned, would actually be only $145 per share, not the full $150 per share. Even more importantly, during a sudden stock price decline, since implied volatility skyrockets, the value of the put often increases so much that the put owner would much rather sell the put in the open market to a willing buyer rather than exercise the put early, forcing purchase from an unwilling short put holder and forfeiting the substantial time value remaining on that put. Early assignment is actually very rare and typically only occurs very close to the option's expiration date. And even then, only if the stock price has fallen extremely far below the put strike price. So bottom line, a short put holder has plenty of time to adjust his or her position prior to facing substantial risk of early assignment. And even if early assignment were to occur, it is merely a minor inconvenience that is easily rectified by selling the assigned stock on the same day as one is notified of the assignment, with no increased margin requirement. This margin-free concept is known as same-day substitution and is offered to option traders by all reputable brokers. And lastly, John, I should add that the potential loss from an assignment can be substantially mitigated by selling put spreads instead of selling individual puts, which reduces the margin requirement and also limits the potential loss to the width of the put spread itself.
Most brokerages place restrictions on which of their clients can buy and sell options. Jim, can you talk briefly about what those restrictions are? And where would you draw the line regarding the sophistication of investors you'd be comfortable advising to buy and sell options?
Sure, John. I just like to start by saying that many of my best subscribers in Velocity Trader or Options for Income or any of my services started off as novices. So just because you've never traded options before or have very limited experience, if you put in the learning curve time necessary, you can become a very successful option trader. But to get more specifically to your question, options are leveraged instruments that can make large percentage moves both up and down very quickly. So brokers are understandably want to make sure that any potential option traders are aware of the risks and understand what they are trading. There are many different types of option strategies, some of which increase your risk, whereas others, such as selling covered calls and selling cash covered puts, can actually reduce your risk. So knowledge and understanding your investment objectives is critical to trading options successfully. In addition to having options knowledge about different strategies, brokers want to make sure you have enough trading capital to open a margin account, because it is a federal requirement that a margin account be opened with at least $2,000 and kept at $2,000 minimum. For reasons that don't make complete sense to me, brokers are more willing to allow novice option traders to buy individual options than they are to allow them to trade option spreads, even though option spreads reduce the cost of investment and risk and increase the probability of profit for small stock price movements, that regional leverage I talked about earlier. Part of the reason they may be hesitant, the brokers may be hesitant to allow spread trading, most likely involves the fact that spreads include the selling of an option, which can be assigned early. And brokers want to make sure that traders who are assigned early know about the same-day substitution rule I mentioned earlier and will routinely close out assigned positions quickly and without prompting from the broker. That's the only reason I can think of that they are slightly hesitant to allow spread trading. What I tell people interested in getting brokerage approval for option trading is to gain the necessary trading experience through the risk-free use of simulated trading programs, also known as paper trading. Several brokers such as TD Ameritrade, Tastyworks, and Interactive Brokers offer simulated trading where you are given play money, imaginary money, to trade options, and this is a way to learn the ropes without risking any real money. Once you have paper traded for a while, you can then honestly tell your broker that you have option trading experience, and they are likely to give you the option authorization you need to trade real options. It also helps to tell your broker that you are a member of a reputable option trading newsletter like those that Investing Daily provides, because brokers know that we only make rational option trade recommendations and we have winning track records. As for where I would draw the line, I would say that Option trading is simply not for everyone. For example, if you have a very low risk tolerance for short-term losses, don't do it, because options have short-term consequences, both good and bad. If your account size is tiny and not large enough to diversify among many different option trading positions, then you should probably stick to a mutual fund, which has instant diversification through just one purchase. If you rely on your brokerage account for regular income distributions and cannot afford to engage in a trading system that can experience periodic losses, options are simply not for you. The ideal option trader is one who has already set aside the money he or she needs for living expenses and any guaranteed periodic income they require elsewhere, and yet still has some extra discretionary money left over for more volatile trading techniques like option trading. For most people, option trading involves speculative directional bets, such as those I recommend in my Velocity Trader service. But these should not be done in a core account, but only with discretionary money that one can afford to lose temporarily. The most conservative option strategies, such as selling covered calls or selling cash secured puts, are a different matter, however, that often do make sense to employ in a core account because they reduce risk. But overall, to sum up, I believe option trading can be fun and profitable for those people with a substantial risk tolerance for short-term volatility, provided they have the account size and discretionary income sources available to take advantage of it.
Well, making lots of money is my definition of fun. I'm a big believer in case studies, real-world examples. Jim, please run us through a real-world example of how one of your trades helped your followers beat the market.
Sure thing. I always like talking about my winning trades. But before recommending an option trade, I want everyone to understand that I screen the stock market using 3 velocity filters, which are a critical part of my trading system. Without going into too much detail on my trading system's secret sauce, if you will, the 3 filters are: number 1, price momentum, measured by means of 2 separate technical indicators. The first being moving average convergence divergence, known as MACD, and the second being stochastic oscillator. Second, I look at seasonality, which measures the number of times over the past 10 years that a stock has risen or fallen in price during a specific time period of the calendar year. And third, I look at max pain option open interest analysis, which searches for extreme imbalances between the option bets that regular investors have made on a stock's calls and puts, and pinpoints the stock price, which will collectively cause regular investors to lose the most money possible on their bullish and bearish option bets. So in other words, we want to make option trades that will make profit at the point where most other regular investors will lose money. We want to be on the side of the option market makers who almost always win. Having a system based on probabilities and risk-reward calculations is very important. After all, option leverage can work both ways, so that trading options can lose money just as fast as it can make money. So if you don't have a time-tested system that puts the odds in your favor, that's a problem. It's similar to playing blackjack in a casino where you count cards and know when the odds favor you winning a hand against the dealer versus losing the hand. You bet big when the card deck has few face cards remaining and the odds of busting above 21 are low, and you bet much smaller, or not at all, if the card deck has a lot of face cards remaining and the odds of busting are high. Probabilities are everything in a successful trading system, and my velocity filters put the probability of success in my favor so that the odds of profit are much, much higher than the 50-50 odds of any random option trade. So to get to the specifics of one of my winning trades, let's go back earlier this year to May 25th, when Las Vegas Sands, which is a casino operator, was trading at $57.75. At that time, I recommended a bearish 57.58 put spread on the stock. This is where we would buy the 58 put and sell the 57 put. This trade had an 11-day duration and required the stock price to drop below $57 by June 4th options expiration, which was the first Friday in June. So it was a very short-term trade, and the timing had to be just right. All three parts of my velocity formula were aligned in favor of Las Vegas Sands dropping in price over the short term. And these indicators gave me the confidence and the edge to recommend the trade. So to list off all of the indicators that led me to make this trade. Number one, MACD was below zero, and the MACD histogram was red, meaning that the short-term MACD moving average was below the longer-term MACD moving average. Crossovers are an important part of the momentum timing system. Secondly, stochastic oscillator, the second part of my momentum indicator, was also in a severe downtrend below the 30% line. In other words, we had a double-barreled momentum sell signal since both MACD and stochastic oscillator were negative. Next, seasonality was bearish, meaning that the stock price had declined between May 24th, when the trade was commenced, and the first Friday option expiration date in June, more often than it had advanced over the past 10 years. And remember, June 4th was the first Friday option expiration in June. Stock price chart was weak and meandering, the LVS stock price chart that is, and had no real direction. So there was relative weakness of the LVS stock chart compared to the S&P 500, which also supported a bearish bias. And lastly, my max pain option open interest analysis supported a bearish trade. There was massive open interest at the June first week expiration 57 call strike of 21,498 contracts, which should have acted as a downward magnet on the stock price because option market makers who had sold those 21,000 contracts wanted to make sure those contracts expired worthless. And where the regular investors were buying those call options, making them worthless would create maximum pain for the regular investor and maximum profit for the option market maker. And max pain itself for the June 4th options expiration was at a stock price of $56, which meant that most regular investors would lose money at $56. So since my system aligns with the market makers and not with the regular investors, this was great for our trade because our put debit spread would make maximum profit at a stock price of 57 or lower. So a max pain price of 56 was even better than 57 and gave us a cushion to the downside. And what happened? Well, at June 4th options expiration, which was the first Friday in June, Las Vegas Sands had dropped to $56.52, and the 57.58 put spread expired for its maximum $1 per share value, or $100 per option contract, since each options contract represents 100 shares of stock. Now, since the initial cost to place this trade was only a 45-cent per share debit, the trade returned a whopping 122.2%, more than a double in 11 days. And this just shows you that very small price moves in the underlying stock can create huge percentage gains when you deal with options and specifically option spreads like I do.
More than a double in 11 days. I think any investor of any stripe would be happy with that. Jim, thanks for your time.
You bet, John. It was my pleasure.
You bet. You know, my colleague Jim Fink just supplied you with invaluable investment advice. You should know that Jim will soon take part in a special event that will show ordinary investors how to make massive investment gains within the next 12 months. To reserve your spot, visit the following URL. Well, that's it for now. I'm John Persinos, and thanks for watching.